Hi everybody, welcome to another update on the Gold Forecaster Index, the holy grail to predicting gold prices. In my last video, I said the rate cutting cycle was going to start, and yes, it will start at some point, and that will be good for gold. So I think there was a seasonal dip last month, and yes, we got a flat month. But it looks like today it's starting to rise. And before we start, let's check the economic data. And we see that jobs are in the red. So worse than expected. We also got a lot of red here. ISM non-manufacturing PMI dropped below 50, even hitting 46. So these are very bad numbers and they are boosting gold higher, as you can see here. So I do expect the economy to worsen, and that will be good for gold. So let's see our latest data points, gold forecaster index using leading indicators. And today we have a positive number. So for May, the gold forecaster index is back to positive. This means that gold will likely go higher. Misery index is flat, but this should go higher with a higher unemployment rate. Inflation is headed back up actually because oil is up, so that could boost it a bit higher. Real output is still, it's bottoming out, so that's also good for gold. The higher it goes, the better. GLD is bottoming out, so it has been dropping, but lately I think this is going to be a bottom. If this starts to rise and the West starts to buy gold, we could see this escalate to 2,500 gold. That's my first target. COMEX gold also starting to bottom. If this goes up, then gold will rise as well. So it's looking great. LBMA also bottoming out for gold to go higher. A little bit less good data from China. Demand for gold is still low. So this is the average and it's below average. So apparently the Chinese aren't buying that much anymore because of the high gold price. Silver is better. So this was the latest data. China silver demand. This is a pretty good candle. Chinese gold imports are still strong, but yeah, we had seen better results before. SLV, yeah, SLV is starting to increase again. So there is some of demand coming now in the ETFs, which is good for silver. And this is still low, but I think the latest data said that it was rising again. So demand is coming back. COMEX, yeah, here as well, demand is coming back. Central banks, they will keep on buying gold. We know that. China data, we don't have the next month yet. I hope they are starting to buy again, because otherwise the market could sell off for gold. Mint sales have increased a bit for gold. Premiums are still low, so that's the other side of the coin. Retail is still not interested in gold and silver. Junk silver premiums are very low. But China gold premiums are still above 1%. So there's still some juice left. This can still drop to 0 like this, and then gold typically goes higher. So 2,500 is a target that I think we will reach at some point as this goes down, and it can even overshoot like this. If we overshoot to the negative, then this could even go to 2,800. We don't know, but we do know that the premium is still above 1%, which is positive for gold, and for silver, premiums are still at 13%. So silver could go much higher if the Chinese win from the West, because the West still doesn't like silver, but the Chinese do. Upmex gold premiums also still low in the West. Maybe they will start buying now because the jobs data is really bad, economic data is bad. Here we still see a lot of commercial shorts. So there could be some slams on gold and silver. But open interest is pretty low here. This can go back up as open interest increases. Gold will rise to new levels. Yeah, this is the tips. It's actually weakening, but it's pretty bullish if gold can keep on rising with weakening tips. Same with real yields. They are actually weakening, but gold manages to go higher. So if this reverses back in a plus, then gold could actually start running. And today is 3rd of July. We are almost at 5th of July, which is typically the bottom in seasonality. So if you want to buy gold and gold miners, now is the time to do it. Because in the second half of the year, gold will rise. Silver, yeah, also silver will have a good return, but not as good as with gold. Gold typically does better in the second half of the year. Sentiment. The sentiment indicator was bullish last time, but I'm happy to see that this bullishness has subsided a bit. Not back in a negative yet, but at least the bullishness is gone. So that means there could be some fuel to rocket higher in gold prices. Big picture, still bullish gold. This needs to go back to here to go to the currency in circulation, which is actually flat today. So yeah, I don't know how, but they managed to make the currency in circulation flat, which is actually not that good for stocks. 30 years to 10-year bond yield is still flat, still waiting for this to move higher, and then gold will skyrocket. Let's look at the Google Trends. Debt to GDP also going up. Debt is currently at the highest level ever. Almost, what is it, 35 trillion? So debt is going up and GDP is not growing that much. So that means this chart will go up and gold will probably follow. Let's look at this Google Trends. Are they buying gold? Is there interest? Apparently not, which is good because then you can be a contrarian and buy it, and eventually interest will come back. Stagflation, absolutely no interest anymore. Everyone thinks that the world is fine, but it isn't fine because latest economic data was not good. Near-term forward spread. Okay, so rate hikes, we will talk about that later as well. So there won't be any rate hikes, probably rate cuts by the end of the year. Or they could pause it until next year. But I think there will be some rate cuts this year. Yeah. This is the target. At least one rate cut should come. Okay, so near-term forward spread. You can see this is the most important indicator, still at -1%. So that's the perfect time to buy gold. Each of these negative points is a good time to buy gold because a recession is nearing. The longer it stays negative, the higher that gold will go. I added the gold lease rate back because I found the data on another site, and this is also looking pretty good. High lease rates, when these lease rates come back down, then gold will go up. You can see that here. If this is down, then gold goes up. So apparently all the data looks pretty good for gold to go higher. Money supply is actually starting to increase again at a slow pace, but starting to increase again, especially M2. So that's good for gold and assets. Let's take a look at the loans. Are we getting more loans? Yeah, a tiny bit of an increase. Not much. Okay. Central bank balance sheets. Let's reload this. Okay, so central bank balance sheets are still dropping. Everyone is selling their bonds, including Japan, apparently. So this is actually the reason why bond yields are spiking. They are selling the bonds, and at some point, yields will start to rise because of this. And this will pull the stock market with it, I think, because stocks are already that high, dividends are not that great. So if yields start to rise, then stocks will probably drop because of the high rates on bonds. So at some point, this needs to reverse and they need to start printing again. And that will be good for gold. Let's see Janet Yellen's wallet. Is there still money? Yeah, there's still money left. So we'll need to wait until November before this gets to zero. And then stocks will probably start falling. but currently everything is still stable. I wanted to look a bit at credit spreads because those are a good indicator for GDP. So this green line is the credit spread and is correlated to GDP. As you can see, lately it has been dropping. So that means real GDP is going to be weak. Oh, the latest data is actually positive. Went back up. Okay. So there is still growth. And what about inflation? Let's see, inflation. So the PPI has gone back positive. That's this line. And the 10-year break even has dropped but gone back up. So we're still in inflation. So I'm going to keep on avoiding bonds and stay in gold. That's what this says. Okay, rate cuts. Let's see. When you click here, you can see what the probability is of a rate cut. So let's look at that. And let's look at September. So for September, we have a 70% chance of a rate cut. That's already pretty high. And for November, less rate cuts probabilities. And December, yeah, then we could go below 5%. So you can see that there is a large chance of a rate cut. And that will be good for gold. Okay, on to deficits. We see that the latest data is pretty bad. Deficits continue to increase, goods deficits. Services are flat, so that's better. The latest data here as well, it's deteriorating. That's bad for the dollar. Here as well. Import price index a little bit down this time, but there's still a gap, so deficits will continue to be high. A little bit of prices declined here in May, but still high. This is still old data. And this is an important chart. As deficits increase, the dollar should drop. I say should, because it has been rising. And smart money is actually bullish the dollar. Not sure why. I wouldn't bet on the dollar going up too much. Capacity utilization has gone back up. And that's good for inflation, but shows that there's a little bit of strength coming back in the US. But okay, so there's no deflationary crash at the moment. I wanted to show this chart. It didn't show up at that time. Okay, deposits still rising and loans still rising. So actually this is pretty stable. I don't think a lot of problems will come as long as this stays stable. So no problems here. Okay, so I did a video on the lumber gold ratio. As you know, lumber has been dropping a lot compared to gold. So we should be more defensive at this moment. Lumber has dropped to 450 in 3 months, and gold has actually moved higher in 3 months. So the lumber to gold ratio is dropping. That is pretty bad for the economy going forward, because that's a leading indicator. So we need to position in gold at this time. There's no other thing that we can buy at this moment. Stocks are too expensive. Bonds, they have problems as well, with Japan potentially selling those bonds. Oil, I'm pretty surprised that oil is going up. I thought this should be dropping because of the inverted yield curve. Typically, oil won't do well when we have a recession. So I'm still positioned in that, in the sense that I don't own any oil companies because I'm anticipating the recession. And gold will do well. Okay. This is a chart of coal consumption. I think I'm getting more bullish on coal, but as you can see here, the West is still decommissioning coal demand. So this could stay weak, maybe for another 5 to 10 years. But you can see that Asian demand is up. So once these guys are decommissioned, then this chart should start rising again, and that's where coal will start rising. So maybe in a few years from now, I will start looking at coal companies, but currently this trend is still dropping. A little bit about open interest. We know that open interest had declined for gold, while the price is in a trading range. Okay. For example, here, this is the gold price. It's in a trading range, and we knew that open interest has dropped. So I knew exactly that at this time, gold is bullish, because as open interest declines and we're in a trading range, that's bullish. It's textbook. And we were right, of course, because gold is now breaking out as open interest probably rises. Okay. Some more data here that you can read. So open interest is the number of long positions plus spreading. You have the commercials, which are the producers and swap dealers. Those are the dump money. Then you have the non-commercials. These are the smart money, the managed money, and the family offices. They have more info, so they dictate the trend. And then you have the dump money, which are the the small speculators. Currently, the smart money is still bullish on gold and silver. And apparently they were very smart because gold is going up. Okay, so that's where I'm positioned now. You can read this. That's about open interest. I saw there was a China gold ETF recently. It's not a lot of gold, but you can see the Chinese have more and more interest. This could escalate pretty fast. This is like GLD starting to trade, and now we have the China gold ETF, which is starting to boom. We also have the India gold ETF, but that has gone nowhere. But looks like China is rising. So this could indeed add a little bit of extra demand for gold. Palladium. Apparently, everyone is starting to get interested in palladium. It is back at 1000. Let's see where it stands now. I heard Mark Faber is pretty big on Sibane Stillwater and Impala Platinum. And yes, it could be a very good trade if the prices get back to 1500 and stay there. If that happens, then Sibane Stillwater will make money again and will probably rise higher. However, I'm not bullish palladium. I don't know why it should go to 1500. Demand is going to drop for that metal in the future. We will get surpluses normally. So I don't understand why this should go higher. Same with rhodium. Where is it now? It's actually doing nothing. It's just flatlined. So no, I'm not participating in the palladium and platinum and rhodium boom. I rather stay in gold. That's a choice. Gold equity valuations. Okay, as you can see here, gold equity valuations are pretty cheap. They are below book value. In the past, they were above book value at 1.5. And the junior gold miners are even cheaper. They are at minus 70% of book value, which is what NAV means. So the value is here and the gold is going higher. So I keep on adding more to the junior gold miners. Commodity outlook, just some commodities. Apparently copper is going to do well next year. Uranium, aluminum and zinc. Oil is not going to do well, and this is Citigroup. Yeah, and iron ore and coal also not good. Manganese has gone up, so now it's dropping back down. I would just focus on gold. Gold is not on here, but I think gold will do pretty well by next year. Oil is peaking. That's McKinsey. They're saying that the demand is still rising, but at some point it will start to peak. So I don't know how high oil can go. I don't think it's a good sector to be in right now. Demand is going to keep on dropping in the future. Production is going to go up in America. So it's not like production is going to drop. So it's coming from the Permian. So the Permian is still growing production. So yeah, for the next few years, I don't see oil going to $100 or $200. I just don't see it. So I'm not invested in that. Silver forecaster index, I did a video on that. Basically, silver is the same as gold, but silver has this gold-silver ratio thing where silver will outperform gold when the consumer price index goes up. So if the inflation rises, then you will see a rise in the silver price more than gold. So this is minus inflation. So if this, for example, goes down, then inflation goes up. And then you see the gold-silver ratio drop, which means silver goes up more than gold. So that's the silver forecaster index. There is this page that you can use. It's still below zero, but it's improving. FOMC, you can see that they have less rate cuts, but there are still going to be rate cuts, I think. So that should be good for gold. More about oil demand, flattening. Oil refiners are shutting down in China. So that's all not good for oil. Nice chart here about China gold demand. And this actually started, so the red lines are China gold demand, and this started in 2008 when we had the crisis. So this will keep on rising and gold will be doing pretty well. Overconfident stock market. You can see that there's too much confidence right now. I expect stocks not to do that well because everyone is too bullish on it. And the last chart, I want to end with the copper balance. As you can see here, Macquarie says that there will be a surplus of copper. So refined balance is going to go up in surplus. Concentrate balance is here in deficit, but also going to go in surplus in the coming years. So that means that the price of copper is going to drop a bit. Well, until 2026. And then prices can rise again. So copper is good for the long term, but there are some signs that we could get back into a surplus. So that's why I'm not participating, but I'm watching it. Let's see where copper goes, but I'm not in that yet. So conclusion is there were a lot of positive indicators for this month on gold. And we are currently at the seasonal lows of gold, which means gold will probably start to move higher. And it is almost 2,370 right now. Probably going to hit 2,500 really soon. And gold miners are going to make a lot of money. Why? Because 2,500 is the price, and there are gold miners with a cost of only 1,300, 1,500. That's a $1,200 margin. $1,200 margin, okay? That's a pretty good margin for these gold miners. And in the past, we only had yeah, a margin of maybe from here to here. That's only $500 margin. Okay, $500 margin, and now we have almost 1,500 margin. So I'm pretty bullish on gold miners. They're going to make a lot of money, and gold is going higher. So this was the update, and I'll see you in the next video. Bye.